Welcome to a special revision webinar looking at aspects of growth and economic development in Vietnam. This is one of a series of short webinars allowing us to focus on particular countries and take some themes common to the A-level economic syllabus, as well as looking at some of the specific contextual detail associated with one particular country. And Vietnam is certainly an extremely interesting economy to be studying at the moment. Vietnam is an economy in transition. It's transforming itself from a state-dominated, centrally planned system into an economy increasingly driven by market forces and, on occasions, where resources are owned by the private sector. So Vietnam is, just to give you a bit of geographical context here, is obviously part of Southeast Asia. The map is a really quite important thing in terms of geopolitics, not least the current conflicts over the rights in the South China Seas. If we think about the TPP agreement, which Trump has opted out of, Vietnam was the only lower middle income country to be a signatory to TPP. It's a country of 90 million people. It's the 14th, in fact, most populous country on the planet. And if we look at the map, Vietnam's location on the kind of easternmost edge of the Indo-Chinese peninsula does make it a really important, if almost a vital link between East, Southeast and South Asia. This is a really interesting country to study for lots of different reasons. Their growth and development model really changed dramatically in the mid-1980s with the Doi Moi reforms. Doi Moi means renovation. The economy had gone through, obviously, the crisis and the calamity of the Vietnam War, all of the loss of human and physical capital that severe conflict entails. In the mid-1980s, after a series of economic crises, they introduced these reforms which try to create a socialist-oriented market economy. In many ways, Vietnam's been quite successful. It made a fairly rapid transition from being a very poor country with extremely low per capita incomes to becoming a low-middle income nation. Indeed, the extreme poverty rate, which is currently measured at $1.90 per day, PPP adjusted, has fallen from nearly half the population 20 years ago to just 3% today. Per capita incomes have lifted from around $100 in the 1980s to about $2,100 in 2015. If we make a PPP adjustment, it's worth between $5,000 and $6,000 per capita. Politically, it's important to note that Vietnam remains a one-party socialist state run by the Communist Party, but one which actually embraces a number of free market policies, which we'll come on to in this presentation. Crucially, Vietnam is a good example of a strongly export-oriented economy. It's made nearly 20 free trade deals with a number of countries, notably with South Korea. It was a signatory to TPP. The European Union's free trade agreement with Vietnam is due to become enforced in 2018. And it's built its growth model on heavy inward investment and in particular attempt to transition away from farming, heavy dependence on farming and low value textiles. If we look at a chart of the fastest growing countries in 2016, we can see that Vietnam does appear in this rapid league table. Okay, this is a snapshot of growth. It'd be probably better to look at a kind of 5-year moving average. But clearly Vietnam is growing very quickly. And here's a chart comparing the growth rate of China with Vietnam. This is taking of data from the IMF. And we can see that whilst the Chinese growth rate has been slowing down from 10% in 2010 down towards 6% next year, 2017, the Vietnamese growth rate actually on a moving average is actually probably gently rising, seems to be sustaining itself at or around 6% per year. So Vietnam, in many ways, is becoming aspects of the rapid Chinese development of 10 or 20 years ago. We can see the consequences of this growth, where GDP is rising faster than population, by a chart showing GNI, gross national income per capita, in dollars, again adjusted for PPP. We can see how China's rapid growth in the last 15 years is meaning that living standards there are converging now on those of Thailand. Vietnam has seen a steady, significant increase in per capita GDP, although Indonesia seems to be outpacing Vietnam as we speak. Can Vietnam continue to achieve these gains in real per capita incomes? Can Vietnam continue on a pathway similar to the Chinese path? Well, certainly their growth pattern at the moment, if you take the left-hand chart here, shows some striking similarities with China's development a decade or more ago. Indeed, Vietnam has become China's manufacturing outsourcing hub of choice, and there are strong, important relationships between those two countries. The right-hand chart shows what will happen to Vietnamese per capita incomes, assuming certain growth rates, and then crucially whether they can sustain a kind of 4% per capita growth per annum. So one of the aspects which is important if you're studying economic growth is whether that growth converts itself into significant and sustained progress in human development. And of course, we use the Human Development Index as a guide. It's not a perfect measure by any means, but it's a useful benchmark. And here's Vietnam's HDI trend since 1990. We can see that Vietnam's HDI value for 2015 was 0.683. Now that puts Vietnam in the medium human development category, and it positions it at about 115th out of 188 countries surveyed each year by the HDI. Its per capita GDP growth since 1990 has been amongst the fastest in the world, surpassed only by China, and you can see that it's risen from $1,400 in 1990 to over $5,000 now. Crucially, there's also been a significant increase in life expectancy at birth in Vietnam. That's partly a reflection of their high healthcare spending. Another way of expressing Vietnam's position is to rank it against similar countries, either in economic or geographical terms. So Vietnam is above the HDI value for medium now. It has a significantly bigger life expectancy at birth. Notice there the gap, for example, between Vietnam and the Philippines have a similar HDI ranking, and it also has a higher life expectancy at birth than Thailand, which is 87th in HDI. But clearly Thailand is almost 3 times as rich in terms of GNI per capita. Mean years of schooling have gone up significantly, now 8 years, but of course there's a big gap between mean years of schooling and expected years of schooling. So can Vietnam perhaps be the next China? Many people are thinking that it has similarities with the Chinese model. To what extent is Vietnam following the Chinese model? Well, the Chinese model has been defined variously by economists and analysts as a kind of hybrid form of capitalism, essentially built on an authoritarian state but with capitalist motivations and incentives. So a kind of authoritarian capitalist model of development. And in a sense, that Chinese model isn't wholly removed from the previous state-centred Asian model of development, which would associate with countries particularly such as South Korea and Taiwan in the early stages of their development. The Chinese model built on gradualism, I think, rather than the shock therapy we saw in Eastern Europe when the Berlin Wall collapsed. Very important role played by successive 5-year plans to set priorities, to send signals to stakeholders, domestic and overseas, to establish essentially a blueprint for development, and also crucially turning points in the objectives of countries. The Chinese model built obviously on control of the exchange rate. For many years China had a fixed exchange rate, control of capital across borders, control of ownership of significant strategic sectors, big focus on investment in primary education, and crucially on trying to cut extreme poverty amongst the bottom 40%, and in trying to limit the rural-urban divide. But both China and Vietnam have had a very similar focus in terms of trying to make themselves more attractive to foreign investment, in particular the creation of special economic zones in industrial areas which offer tax incentives for businesses setting up. There are some subtle differences, however. Vietnam is probably best described as a socialist-oriented market economy. And although it's probably not the time and the place to go into depth on this, a lot of people suggest that Vietnam has maintained more of their pre-communist traditions and cultures than China did. There's obviously clearly in Vietnam a much higher ratio of consumption to GDP. It's very low in China. Vietnam typically has operated a managed floating currency for longer. China gradually moving towards that. And Vietnam, one of the big differences is that Vietnam is a much more open economy. The export to GDP ratio is close to 90% now, whereas for China it's only about 40%. Despite the politics and the military events of the 1970s, Vietnam has strong connections with the United States. It's the biggest export partner and important military ties. Just in 2016, before he left office, President Obama lifted the ban on exporting military equipment to Vietnam. So hints that there is a deeper entrepreneurial culture in Vietnam, something akin perhaps to Singapore or South Korea. And a contrast is that the Vietnamese state, the Communist Party, has actually been slower than China to privatise or equitise many state-owned businesses. The crucial point, I think, in the context here is that Vietnam has a very large and young and educated population. Literacy rate is 94%. And essentially, Vietnam's growth has been built on being a very open economy. So where is this fast growth coming from, this 6-7% growth of GDP? Well, lots of contributory factors, both on the aggregate demand and the aggregate supply side. Crucial to this has been the impact of inward FDI, which we'll look at in a second. So that's been a major injection of demand into the Vietnamese economy. Vietnam runs a net trade surplus, which of course adds to net aggregate demand. It's seeing a rise in per capita incomes, which together with an emerging middle class is augmenting consumption. Demographics have been favourable to Vietnam, both in terms of natural population growth and also having a very young population with a low median age. Productivity has increased, notably in sectors affected by FDI, less so in industries that are a bit more protected. There's been big investment in recent times in tourism. That's going to become a key driver of growth in the years to come. And the state has invested heavily, sometimes with public-private partnerships, in big infrastructure projects, notably in energy and in transport. And no country on the planet has ever become rich before without urbanising. Urbanisation is continuing apace in Vietnam. So there are many drivers of growth in the Vietnamese economy. Here's some background on this. So this chart shows capital investment, gross investment, in real terms as a share of GDP. You can see here that clearly Vietnam lags China in terms of investment. Chinese capital investment since 2008 has been staggeringly high, sometimes close to 50% of GDP, but never less than 40%. Vietnam is a league below, and it has major infrastructure needs, particularly in the fast-growing cities. So by most economists' reckoning, they'll probably need to lift that investment ratio closer to 35% of GDP. And to do that, they'll need to raise the savings rate to build their capital stock. One of the big features, one of the really significant features to take out, I think, of this session is that Vietnam is one of those countries with a very heavy dependency on and impact of foreign direct investment. Now, the chart shows that Cambodia leads the way. In 2015, foreign investment nearly 10% of GDP. But Cambodia is a tiny economy compared to Vietnam, and Vietnam is tiny compared to China. So sometimes the data can be a little bit misleading. But FDI into Vietnam, there's a couple of good examples there from LG and from Samsung. FDI is on track to break another record in 2017, as it did in 2016. Essentially, a lot of investment coming in, attracted by low unit labour costs, improving infrastructure and skills, a pretty deregulated, business-friendly business environment that's increasingly open to sort of 100% foreign competition. And crucially, a lot of FDI flows into Vietnam are linked in part to a shift in low-wage production from China. So as China hits the lowest turning point and wages rise at double digits, there's been a lot of manufacturing FDI removing itself from China into Vietnam. South Korea is the biggest source of FDI. I think it invested over $7 billion in Vietnam in 2016, and quite significant sums that is in a small country. One of the advantages that Vietnam has, which I think is worth noting, is that Vietnam really does excel in sort of international tests. We have something called the Programme for International Student Assessment, or the PISA rankings. And even though I think they take something like 80 countries, Even though Vietnam had the lowest GDP per capita of all the countries studied, the performance of Vietnamese students exceeded many OECD advanced rich countries. For example, Vietnamese average score in maths was above that of Austria and only just below that of Germany. This chart hints that Vietnam is on a par in terms of math mean scores with Poland, Estonia, etc., but at staggeringly lower levels GDP per capita. One aspect here, though, is that their measured score was increased because about a quarter of Vietnamese students are no longer in school by the age of 15. So their lower performing students are more likely to have dropped out of school, which will lift their average, of course. Healthcare spending in Vietnam is significantly higher than relevant countries. It's over 7% in Vietnam, reflected in some good HDI scores, in particular lower maternal mortality than for many of the lower middle income countries. So healthcare spending as well as education is important for Vietnam. And I said before that urbanization is continuing apace. So 2005, just over a quarter of people lived in urban areas. By 2015, that's now up to a third and obviously rising. Vietnam already has some very large cities. Hanoi would be a good example. I think somebody quoted me that there were 10 million people in Hanoi and 11 million motorbikes. So try and work that one out. Urbanization generally helps emerging frontier economies like Vietnam because it helps them become more productive. Cities grow and they encourage economies of scale in production and distribution. Businesses in cities tend to benefit from knowledge transfers and also they benefit from a much more bigger and diverse pool of labour when they're surrounded by lots of other businesses. We call this agglomeration effects. So urbanisation is likely to drive Vietnamese growth going forward. The demographics at the moment also are pretty good. As we said, the 13th most populous country in the world, 90 million people, so a potentially huge market. A median age of 30 at the moment, but as you can see, the median age is rising. At the moment, Vietnam has a very young population, but clearly that demographic sweet spot won't last forever. Crucially, I think this is really important, is that Vietnam's growth and development has been built on being a very open economy, extremely open economy. Trade for Vietnam, if you add together the value of exports and imports, trade accounts for nearly 200% of their GDP each year. So in other words, a lot of that, of course, is the imports come in, that counts as trade, and some of those imports are made into exports, and that counts as trade as well. So that's why you get that more than 100% of GDP. But trade accounts for roughly 180% of national output, and that is more than any other country at its level of per person GDP. And you can see it's well ahead of Cambodia, well ahead of Thailand, of course, streets ahead of Indonesia and China. So the Vietnamese growth is built on being an open economy, developing, expanding capacity and capability, particularly in manufacturing. Again, this chart reinforces it. It's just the annual growth of trade with Vietnam. I think in 2014, Vietnam's exports were about $150 billion, 3/4 of which actually are manufactured goods. And of course, a lot of that is powered by foreign direct investment. In fact, FDI into Vietnam has come from more than 100 different countries over the last 10 years. And crucial to this whole debate is about where Vietnam's competitive advantage now lies. And it's probably increasingly in manufacturing, but what types of manufacturing? So Vietnam, according to the latest Deloitte survey of global manufacturing competitiveness, Vietnam is ranked 18th out of 40 nations for manufacturing. And they reckon by 2020 they could be nudging towards being the top 10 most competitive manufacturing nations on the planet by 2020. Part of this, of course, is labour costs. Their labour costs are less than $2 per hour. Labour productivity in manufacturing in Thailand is nearly $9,000 per capita per year. Keep in mind, of course, the GNI per capita is just over 5,000. So manufacturing in Vietnam is significantly more productive than the rest of the economy, and nearly 3/4 of the value of exports come from manufacturing. Partly this, of course, is low labour costs. It's also their geographical location. Proximity matters a lot in international trade. So Vietnam is kind of clearly, in terms of manufacturing, one of the main beneficiaries of the economic development currently underway in Far East Asia. It's an export-oriented manufacturing nation, and a lot of, especially North Asian corporate groups, businesses need to find a new, less costly base for their production, and they're tending to move away from China to countries like Cambodia and Vietnam. Here's the Deloitte survey, and it just picks out the point that Vietnam is likely, according to their survey, to up the league table into the top 12 by 2020. The UK forecast to drop from 6th to 8th. And within that, of course, you're getting the emergence of manufacturing clusters in the regional economic context. So United Kingdom and Germany are Europe's biggest manufacturers. There are other sectors, other countries with smaller sectors. And you get this big cluster of manufacturing countries in East Asia. Deloitte talk about the MITIV, or the Mighty Five: Malaysia, India, Thailand, Indonesia, and Vietnam. All of these countries, according to Deloitte, have a competitive advantage over China, in particular in making manufacturing labour-intensive products like textiles, clothing, toys, basic consumer electronic products. Here is Cesar Hidalgo's wonderful work on the pattern of exports, and this is currently Vietnam's patchwork quilt of export sales, just for goods, ignoring services for the moment. High-tech manufactured goods, especially things like mobile phones, electronic equipment, TV screens, they now represent nearly a third of Vietnamese exports, compared with less than 10% in 2010. Keep in mind also that Vietnam is also a producer of rubber and oil. 2% of its exports crude petroleum. If you want to know the details, it's also the world's biggest exporter of cashews and black pepper. It's the second largest exporter of coffee and cassava in the world. It's also the third largest exporter of rice and fish. So clearly Vietnam has some significant comparative advantages. It's a very open economy, still relatively poor, but growing quickly. A little bit of a change in the pattern of exports is evident here. You can see the rise in particular since 2012 of telephones and spare parts as a share of exports. That is the direct result, clearly, of the inflow of foreign investment in the likes, for example, from the likes of Samsung, big investor in Vietnam. Tourism, increasingly part of the Vietnamese growth and development strategy. There's a whole aspect of this about the costs and benefits of tourism for countries like Vietnam. We have a separate video on this on our YouTube channel if you want to check that one out. The primary source of tourists for Vietnam is still China. It used to be Russia, but Chinese tourism has taken off, along with obviously increasing numbers of Western tourists. And it's clear that Vietnam's mountains and coastal landscapes should make it a really attractive tourist destination, providing, of course, they've got the capacity, the capability, and the infrastructure to meet demand. And keep in mind that the challenge that rapid growth of tourism has for sustainable growth and development. Another aspect, I think, really is this idea of where Vietnam is building its capacity and competitiveness. So this is taken from a very significant report from the World Bank. Vietnam has about a 0.7% share of world exports, but some sectors are much bigger than that. So take, for example, telecoms increasingly now, and footwear and coffee and seafood. They're bigger in terms of the world market share than Vietnam's overall share of exports, 0.7%. Crucially, I think, for Vietnam to succeed, to continue to grow, to modernise, to develop, to get to upper middle income levels, Vietnam needs to support the growth more of these industrial clusters and crucially link them with global supply chains and value chains and build the talent that Vietnamese clearly have. Biggest export partner for Vietnam is the United States. China comes second, Japan third, South Korea fourth, Germany fifth. And of course, in 2018, Vietnam's free trade agreement with the European Union comes into force. So Trump's decision to depart from TPP is potentially significant for Vietnam, because the United States, of course, is their biggest trade partner, and that fall in tariffs that was expected could affect Vietnamese producers quite hard. The current account for Vietnam is quite interesting. The current account is broadly in surplus, fell quite sharply in 2015, but basically Vietnam runs a current account surplus, and that of course adds to demand. Notice on the right hand side, if you follow the green bit, that there's quite a strong net flow of remittances coming into Vietnam, equivalent to a substantial chunk of GDP every year. That adds to their GNI as well as improving their current account and the balance of payments. The diaspora, of course, people who left Vietnam, many of whom left, hundreds of thousands left during the conflict in the 1970s, some of whom are coming back to set up businesses in Ho Chi Minh City. Others send their money back, and so that's a regular source of money flowing into the Vietnamese economy, a useful source of dollars. Investment income is negative, and you kind of expect that. That's the blue bit in the right-hand side diagram. You'd expect that because there's been such a surge of inward foreign investment into Vietnam that the profits made by LG and by Samsung will leave the economy and flow back out again. But crucially, Vietnam is running a current account surplus, largely on the back of quite a strong trade surplus there, in goods especially. The exchange rate is quite interesting. So whereas China operates a sort of semi-fixed exchange rate system, Vietnam operates with a managed floating system, a managed floating exchange rate, and that's shown in the chart on the left-hand side. And if you want the national currency values, they're on the right-hand side. The external value of the dong, which is the Vietnamese currency, by the way, is adjusted daily to a basket of foreign currencies. It's not just adjusted to one currency, they use a basket. And it can move around by a maximum of 3% around a trading band with the United States dollar. In fact, if you go to Vietnam, many places, shops and restaurants and hotels will accept US dollars, but the merchant, the hotel for example, or the restaurant, will actually apply their own exchange rate, which tends not to be favourable. So we've painted a picture, I think, of rapid growth in Vietnam, a country that's lifted itself from being one of the poorest on the planet to middle income status and hopefully much more. Let's just finish by thinking about some of the barriers to growth in Vietnam, in particular some of the constraints in both the short term and, more importantly, I think, the longer term challenges and risks going forward. First point I want to make is this, that Vietnam remains a very small economy. All I've done here is I've just plotted on the chart the value of annual GDP in both countries, PPP adjusted, and you can see that although Vietnam has grown, its size relative to China is tiny, although geopolitically it remains important. So it's still a small but highly open economy. What are some of the big challenges? I think the environmental challenges cannot be understated. They are significant. According to some estimates, Vietnam is one of the countries in the world most at risk from the likely consequences of man-made climate change. And the rapid growth in recent years has clearly caused some damage. Big part of their protective mangrove forests have been destroyed. There's evidence of overfishing, depleting nearshore fisheries. That poses obviously threats to coastal livelihoods. There's been the removal of deforestation in upland areas. And of course that's contributed to more frequent and oftentimes severe flooding. So Vietnam is overall, for example, water shortages. Agriculture uses 82% of available fresh water in Vietnam. Overall, Vietnam is one of the world's most vulnerable countries to climate change, particularly in the Mekong Delta. And that's both a big challenge to Vietnam, to their growth, but also in many ways an opportunity, particularly if they can invest heavily in renewable energy and in more sustainable forestry and irrigation systems. Although Vietnam has made progress in becoming more business friendly, it's still not ranked particularly highly by the World Economic Forum. And here are some of the key factors for doing business. An educated workforce, we've said that actually their workforce is quite well educated, but there's quite a big dual economy, so there are millions of people still in farming who are essentially uneducated. Access to financing is difficult. Corruption is obviously a major problem, particularly in a communist state. One of the big problems in Thailand is that farm productivity remains low. So we've tended to focus in this presentation on the impact of FDI in particular into Vietnamese manufacturing. But actually what you have in Vietnam is the classic example of a dual economy. You have a fast-growing, increasingly productive industrial sector, but you have a low productivity farm sector employing millions of people, and unless productivity can lift itself, there's unlikely to be a significant improvement in living standards in farm areas. So these charts are quite important. On the left-hand side, agricultural value added per worker as an index. Vietnam has struggled since 1990 to achieve the gains seen particularly in countries such as China and Malaysia. And if you look at value added per worker just in real dollar terms, $2005, you can see that Vietnam is significantly less productive than countries like Bangladesh and India and China and other countries. So that is a major barrier to growth. Vietnam needs to commercialise and reform its farm sector. Geopolitical tensions also hugely important, as you can see here, a little map showing the sort of South China Sea. These tensions are not just applicable to Vietnam as well, but to other countries as well. Here's a kind of summary slide showing some of the barriers to growth in Vietnam. So we've mentioned the country is vulnerable to climate change. As a highly open economy, it's also exposed and vulnerable to a significant slowdown in one or more of the United States, China, Japan, I think in particular in South Korea. Their export sectors are heavily dependent on those countries. Vietnam also has underdeveloped land, and it also has financial markets that are really underdeveloped. The stock market only opened in 2000. Another long-term threat to Vietnam is whether Vietnam can grow rich before the impact of automation and robotics takes away some of their advantage in manufacturing. A lot of those manufacturing processes, which employ a lot of people in Vietnam at the moment, are becoming roboticized, if you like, machine learning, artificial intelligence. Can Vietnam cope with that? It needs to overcome the dual economy problem. There's also an argument that Vietnam is probably over-reliant on foreign direct investment. In that sense, Vietnam could be quite similar to Mexico. And perhaps the biggest threat to Vietnam is the fact that it's such an open economy that if there are moves afoot towards greater tariff protection and non-tariff barriers, if the process of globalization goes into reverse, Vietnam as an open economy may struggle to sustain its export-driven growth. Okay, so final point is really to think about the middle income trap, that Vietnam's a really good example of a country that's reached middle income, but we know from experience that many countries then fail to get beyond middle income levels. Typically their growth rates slow down before they successfully transition to high income. So I think anything on the middle income trap, again we have a video on this on our YouTube site, could be interesting to think about. Will Vietnam suffer, for example, a productivity slowdown? Can the country successfully transition from being a country where growth is driven by more inputs towards a country where growth is driven by more innovation and higher efficiency? The demographics may start to turn against Vietnam in future years. And of course, there's always the risk that there'll be some sort of recession, maybe a credit binge or external debt crisis, which will kick in at some point. The essential point is where Vietnam is now, it's made significant progress. It's got itself to low middle income levels. But the next few years will be crucial to whether it can sustain that growth and turn it into inclusive growth and development. So there we go. Vietnam is a country in transition. It's a fast-growing country. It's definitely a country of the future, one to look at in some detail. And hopefully you found this a useful case study in growth and development.